to pay off the debt. It's like a desperation paper. But if you get something that's like, oh, pays 3.5% treasury bond, it's a T-bill, it's a T-bond, it's a 10-year, it's a da-da-da-da-da. Credibility is you're guaranteed to get paid on this, right? So the lower it goes, rates go up. We were talking about this yesterday, Brandon, so I'm going to come to you here in a minute, but I want to play a clip for you guys from Jamie Dimon. Rob, if you can play the clip of the crack in the bond market, if you have, is this the one?
This is it.
Go for it, Rob. Play this clip.
These are very large numbers. You've seen it a little bit. You had the crack in the bond market in COVID a little bit. The government did the right stuff, then they massively overdid both spending and QE. We borrowed and spent $10 trillion from 2020 to today. Wow. Okay, and you heard the numbers before. We also bought $4 trillion of your securities on top of the $4 trillion we bought in the first go round. Those numbers are true globally, not quite as big as ours, but the QE of us was $8 trillion, the QE of the rest of the world was another $8 trillion or something like that. You're talking about huge sums of money. We don't really know the full effect of that. And the bond dealers, which Gary mentioned, inventories are much smaller than they used to be, partially because of rules and regulations. And you are going to see a crack in the bond market. Okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money, and then some of my friends will tell me that we like crises because it's good for J.P. Morgan Chase. Not really. I tell people when Credit Suisse went bankrupt with the First Republic, it was terrible for the banking industry. I think we can make everything better, including that, by just changing and modifying certain rules and regulations, letting market makers intermediate more in the market. But to give you a number, like just J.P. Morgan alone buys and sells $3 trillion a day, and we move $10 trillion a day of money, and we're probably a tenth. So the money moving around the world is $100 trillion a day. The money moving around the investments, this is stocks, bonds, corporate governments, derivatives, credit, you name it, FX, sovereign debt around the world, 30 trillion. The people who set those long-term rates are those people, including you in the room. It's not the Federal Reserve. They can try to manipulate the long-term rate. They can do what's it called? They do the twist or whatever. It doesn't work for that long. So if you look at economic history, bad things happen. When those tectonic plates shift, it's very hard to see in real time. It is shifting, and this is one of them. I just don't know if it's going to be a crisis in 6 months or 6 years. And I'm hoping that we change both the trajectory of the debt and the ability of market makers to make markets. And also remember, there are a lot of people, going down to Washington who actually like bad markets. And the problem with the bad markets isn't that it's bad for the big banks who make markets. It's bad for the people who raise money, small businesses, asset-backed securities, middle market companies, corporations, the United States government. And that volatility scares people.
Right there. He almost said it, but he didn't want to say it. Of course a bad economy helps these guys out. Didn't they buy up a couple companies last time? And, anyways, Brandon, your thoughts on this?
Yeah, he's saying the bond market's going to crack. I don't know how we could say the bond market's not cracked already. I don't think it's a normal thing at all for the Federal Reserve to own